segregation.
Let's see if I can actually circle it now. Red. Okay. There we go. It's these three right down here. And the reason that is because depending on the length of stay on an Airbnb, the IRS is either going to treat it as rental income or it's going to treat it as ordinary income. And there's three categories you could fall into. If you 7 days or less per stay in an Airbnb, it's not rental income, period. Never is. It's ordinary income. And it can be active if you're materially participating, which there's 7 rules for material participation. That could be a good thing or it could be a bad thing, depending on if you're making money or losing money. If I can create a paper loss through the depreciation strategy I'm going to show you here in a second with accelerated depreciation, that simply means that I could have active, ordinary loss that offsets my W-2 income. And I'll let that sink in just for a second. Your real estate activity, if it's Airbnb, 7 days or less, and you participate in it, can become an active loss that will offset all of your other income sources. If you are 8 days to 30 days, so we are 8 days to 30 days, and you provide extraordinary services, substantial services, extraordinary is over 30 days, substantial services, which just means you're doing more than just what a hotel would do. Like you got to be bringing them meals, doing some cleaning every day, giving some sightseeing, probably a concierge. Then even if it's averaging stay 20 days a month, you could be considered non-rental. It could be ordinary active income, especially, and then if you materially participate, that would unlock it so it's not a passive activity. If you don't materially participate, then it's a passive income from a business. It's not rent. It's weird. If you are over 30 days and you provide extraordinary services, and the easiest way I can explain this one is extraordinary services is like if you're doing a treatment facility and people come there and they do 30 days, a minimum, probably 60 days, and they're kicking alcohol or drugs or something, you aren't renting. You are running a business, and the rental activity is a part of that business, that's all. But it's still non-rental income. It's ordinary active income if you materially participate. Any losses are going to be ordinary losses. Any income, if you're actively participating, would be subject to self-employment tax. It's just a business. So all three of those could be just a business. How does it work? 7 days or less. That's your typical VRBO, Airbnb, because the average is about 3 days. But let's just say you're doing that. And I'm just going to give you guys an example. This is Clint's strategy. So if you are a high income person, so you're making, let's just say, over $200,000 a year, call that high income, and you put a piece of property into service. Let's say that you're about to close on something. Is anybody about to close on a rental property before the end of the year? Just putting in chat that you're going to close, because I want to use your scenario, if that is. Yes, somebody says, all right, so Benny, there's a bunch of you guys. All right, so for all you, a ton of people, yes, 2 properties. Okay, if you guys make those into Airbnbs till the end of the year, I could probably get you 20% of that property value written off this year against all your other income sources. Is that exciting? Has to be single family or a duplex. It doesn't really work for, somebody says I have 168 units. Vanessa, I don't think it's going to work for that, but we want to Airbnb it. And you need to manage it. And you only do this, condo works too, you only do this till the end of the year. And here's why. We put it into service. We take the total number of days divided by the unique bookings. If it's 7 days or less, it is ordinary income. It's not rental income. If you're the one managing it, nobody else can say they managed it. It's active, ordinary income. It's just a business loss. You can take it against all your other income. So let's go back up to Benny since you were the first one. How much is the property you're closing on, Benny? If you're willing to do it. 150,000. Hey, Benny, if you even get it rented for a week, all that we care about is what's the average days of use and was it in service during 2021. And here's why it's important. Because when we accelerate depreciation, I'm going to let the cat out of the bag here for a second. It's just like buying a piece of equipment in your business at the end of the year. When we use accelerated depreciation, it doesn't matter how long it was in use for. It could be one day. As long as we had it in use and we could show that our average tenancy or average guest was there for 7 days or less, it's an active, ordinary loss. On $150,000, I could tell you you're probably going to get about a $20,000 to $30,000 loss. Pretty easy. Actually, it's probably going to be more than that. So let's just say, yeah, probably $30,000 to $45,000. Let's use somebody else. Millionaire. Somebody millionaire mindset. You're out there. Or Michael, give me what your price. I'm closing on a $700,000 property. All right, you'd get about probably a $200,000 deduction this year if all you did is put it into service before the end of the year. We can do the accelerated depreciation, and then next year, 2022, you hire a manager and you let them manage, because all we care about is during 2021. If we can meet that test, it's ordinary. If it's 8 to 30 days, there has to be substantial services for it to not be rental. And I don't see this ever. And then more than 30 days is extraordinary. And that is a business really plus just has real estate. Has real estate for its customers. So i.e. Drug clinic, drug recovery, alcohol recovery, any sort of recovery, any sort of therapy. If somebody's staying there more than 30 days, but they're there because they're receiving a treatment or because it's something, it's like it's ancillary. The reason they're staying isn't for the real estate. The reason they're staying there is for some other service, but the real estate's there. Somebody says, which one is better versus the Airbnb? Rental versus Airbnb? It depends. The Airbnb makes you a lot more deduction in first year. So if we're towards the end of the year, we want to go like crazy. Somebody says, I closed on my property in March, which I intended to Airbnb ASAP, but had to do repairs. It's almost fully ready. Purchase price $260 and we put $40,000. Could we do it? Yes. All you have to do is put it into service and make sure that you're doing it for Airbnb or 7 days or less. So VRBO, Airbnb. The IRS treats you as a hotel. And now I'm going to show you how the accelerated depreciation works so I can get you guys good and excited. See, we're going to make a whole bunch of people a bunch of money. What if we have 0 bookings? You're going to have a tough time. You could show that it was available, and what will happen is they'll look at 2022 to determine the nature of the property. So if you were able to put it into service in 2022 as an Airbnb and you still managed it, it would work for 2021. But if you are just doing 2021 and then you're going to make it into a rental, you got to do it. And somebody says, what if we don't have any furniture? Rent some furniture. Can you rent it to a friend? You can, but make sure that it's arm's length and that they're paying you. So, top 3 tax benefits CPAs miss. Gosh, are we having fun yet? Like some of you guys should be like, yay. Can the same thing be done for Turo car rentals? Yes, because Turo car rentals, you actually have to do the actual depreciation methodology. If it's used 100% this year and it's a Turo car, like you bought a Tesla X, you would get the entire amount deductible this year, especially if all it did was Turo. And you don't have to worry about the days on Turo. It's always an active business because it's not rental real estate. See, Claudia, and this is why you come hang out with tax lawyers. We're a heck of a lot of fun. All right, top 3 benefits that CPAs miss. Failing to depreciate 5, 7, and 15-year assets under the Tax Cut and Jobs Act. We go like this. Why don't you do that? Stop it. The CPA doesn't know how to group activities. They don't realize that if you want to be a real estate professional, you have to elect to group all your activities. Here's a fun one. If you self-rent, somebody says so much fun. If you self-rent, so let's say I'm a dentist and I own my office, I can treat that activity as one activity. I don't have to treat it as a rental and a dental office. I can consolidate it all. It's called grouping. I'm allowed to do it. A lot of CPAs don't know it, and then they just use the wrong entity. How do I know they use the wrong entity? Because 70% of people are still set up as sole proprietors. 70% of the businesses out there are set up to where it's probably doing a disservice to the client. Somebody says, so just confirming, can we do Airbnb for the rest, for less than 7 days of 2021 and then put it in long-term rental and get the benefit in 2022? So yes, it's better to do multiple, but technically you meet the requirements. If they look at you and say, well, that really wasn't a 7 days or less, that was you just giving it to the same person and then they stayed in it the rest of 2022, they'll relate it back. But I don't know, as long as it's to a third party, put it on Airbnb, make it available for use. That annual use is a business, it's not rental activity. Voila, it's an active business. You have active ordinary income. You have a big loss for the first year. That's great. Let me show you how it works. First off, I'm going to give you guys how depreciation works. Because depreciation equals deduction. A deduction works like this. You make $1, you spend $1, you have zero taxable income. So a depreciation works as a deduction. Even if you borrowed the money, so it doesn't matter, like end of the year, I tell people get your credit cards out. Like if you're worried about your tax bill for 2021, like you're saying, oh, I had a really big year, buy anything that you need for 2022, get your credit card out and buy it now. Pay it off next year. Why? Because it's a deduction the year that you actually buy it. You put it on a credit card, it's deductible this year, even if you don't pay it till next year. So let's talk about this. Whenever we're doing depreciation, we have to look at and break out what the land value of the real estate is versus the improvement. So if I have a piece of property, so I buy a house and it's on land. This is land. Land is not depreciable because it doesn't lose its value. The house is going to last 27 and a half years under MACRS, Modified Accelerated Cost Recovery System. So they say, oh, if it's a single family residence, it's 27 and a half years. If it's non-residential, it's 39 years. So the IRS says that property will last 39 years. Like if it's a commercial building, oh, it's going to last 39 years before we have to replace it. Now, anybody who owns property knows you're replacing it as you go. Like you're replacing the roof, you're fixing the walls, you're fixing the foundation, you're replacing stuff, you're repainting it, you're doing the carpeting, you're doing all these things. But the IRS says the default rule is that it's all going to last 27 and a half years. Your carpeting is going to last 27 and a half years. Your plumbing is going to last 27 and a half years. Your sidewalks are going to last 27 and a half years. Your shrubbery that you plant out there is going to last 27 and a half years. The fence you put around there is going to last 27 and a half years. Your cabinets are going to last 27 and a half years. And anybody who's in real estate also knows that that's a bunch of crap. It doesn't happen. So we are going to break this out, figure out what our value of our house is, and then we may do a little twisting on it. We may accelerate some of it because we know that the carpeting, for example, isn't going to make it 27 and a half years. That's 5-year property. And Shrubbery says, makes me think of Monty Python. Some of the best scenes ever. Life of Brian, I always like the end. But also the Holy Grail. Come back here. What is it? You bite your legs off. Anyway, Monty Python for you guys have to, I guess maybe that's a generational thing. Purchase price plus closing cost is going to get you the actual value of your house. So if I say, I'm going to use as an example, $300,000 house, that's the purchase price plus the closing cost. If you put a bunch of improvements into a property, so I bought it for $250 plus I closed, I put it all together, it's $300,000. That's what I'm using. And then I subtract off the land. So how the heck do I figure out what the land value is? Well, I could either use ratios based on the assessment, or I could actually use an appraisal. And so I could use ratios by saying, all right, let's say that I have a piece of property, I bought it for $300,000, but the assessment is $100,000, and the land is 20% of that. So I would just say 20% of $300,000 is my land value. Or I could get an appraisal, and the appraisal might say, oh, your land value is higher. It's $100,000. Well, then, oh, nuts. I want to make sure I use the assessment ratio as opposed to the appraisal. I'm allowed to pick whichever one's in my, you guys see, we got some Monty Python fans. There we go. We're starting to see some activity there. But we get to pick whichever one's in our best interest. So let's do an example. You purchase a house for $300,000. You guys know the rules. You get to do the purchase price plus improvements plus the closing costs, but we're just going to say this is inclusive. It's $300,000. It includes everything. So we do the assessment, and say it's 20%. The property was assessed at 100. You guys can all pull this stuff up in the county websites, or when you're closing, you can look at it, or you can get an appraisal. A lot of you guys do like to do the appraisals, and you could use that. But either way, we get to pick. Here I have an assessed at 100 or appraised at 300. The land value of the appraisal is 100. The improvement value is therefore 200. But the land value has it at 20% for land, which means 80% is the improvement value. 80% of 300 is 240,000. Which means I get to pick whichever one's in my best interest. I'm going to pick the 240,000. So when I go to figure out depreciation, I now have this 240,000 as my depreciable basis. That's this number right here, right? Easy way to think about this is if I add the land, I will equal the purchase price, right? So that's the 240. That's where that comes from, so I don't lose you guys. I literally just divide that by 27.5 to get an idea of what it's going to be approximately. Because in all reality, depending on when you buy it, is what time of the year that we use. It's going to be a proportion of it. The IRS makes us use a half-year convention. So we're going to get, for example, in the first year, it might be 4,400 that we get to use. And then the next year, every other year, it's going to be 8,800, right? It always depends on the facts. But for purposes of illustration, I'm just going to divide it by 27.5. This is just to illustrate. Your numbers will always be slightly different depending on when you bought it. For like right now, if you bought it in November, I think they're using a half month, or they're going to use December 15th. So it's going to be just a little bit different. This is your straight line. So this is the MACRs. We won't be able to write off a ton under MACRs. If I did just regular straight line depreciation, which is the 27.5 years, that's when they meet by straight line. Hey, I'm just writing it off, equal tranches over the entire life of that property. My approximate yearly depreciation is $87.27. Let's say that I get $2,000 per month in rents, so that's $24,000 a year. I pretty much say the rule of 50%, I'm going to have net operating income around 50%. And that's because I put money aside for my CapEx. A lot of you guys are going to say, all right, it's going to be a higher net operating income. Okay, I get that. But I'm just going to use for my purposes what I see year after year is pretty much a conservative number is 50%. If I get $1,000 in rents, I think I'm going to see 500 of it. But for tax purposes, I take the depreciation off. So I would have an $87.27. So let's say I bought this property for cash. I bought it for $300,000. I'm going to get a first year deduction of approximately $8,700. So I'll only pay tax. This is going to go as a K1 on page 2 of my Schedule E. If it's a partnership, if it's individual, it's just page 1 of your Schedule E. But I'm going to have net profit showing up of $3,273 a year. So you can look at it and go, shoot, I really don't want to get hit with that. I'm in the highest tax bracket. Maybe I'm in California and my state beats the crap out of me too. So I'm going to be at 50% tax. I really hate that. So the solution is always going to be to do a cost seg analysis. And if you've never heard of a cost seg, good, this is your lucky day. In a cost seg, we take the property, the improvement. We take the house, and the roof, for example, is 27 and a half years. But the door might be 5 year. The carpet might be 5 year. The sidewalk might be 15-year property. And what we're doing is we're breaking it all out. The picket fence that goes around it, that might be 15-year. And then all the little shrubs around it, trees, 15-year. So we break it into its components, cabinets, all of that. And we decide, well, wait, I might have much shorter depreciation lives. If I'm having to depreciate, let's say the average for us is around 30% of the improvement value. So if 30% of the improvement value is less than 15 years, I'm accelerating a lot of that. I'm going to have a lot more depreciation. So I look at the analysis. I look at that, and by the way, we get them done free. We don't do the cost segs ourselves. We outsource that to a really good firm that's all they do. But they'll do the analysis for free for Anderson clients. If it makes sense, and I usually look, if it's going to give me a 100% return, 7x return, I'll probably do it. So if it costs me $2,000 to do a study from a third party, I want to see $14,000 in my pocket. I want to have cash in my pocket, not deduction, cash. I want a bigger deduction. And then you can do this at any time with any property you have. If you own a property for 5 years, we can still do it. If you buy a property, we don't even have to do anything. Like we could just implement this in year 1. If it's year 2, we'd have to do a change of accounting. And if we create a loss, then we have to look and see, is it a passive loss from rental activity? We offset our passive income, but if we have extra passive loss, we can either carry it forward, right there, or we need to see if there's an exception to the passive activity loss rules. And this lives in a provision 469C7. So it's IRC 26 USC 467C7. And you could be a real estate professional or an active participant. A real estate professional, one spouse has to qualify as spending half their time and more than 75% of or 750 hours during the year. So more than half of their time, what they're doing work on. And you're doing construction, reconstruction, improvement on properties, real estate agent, you could be a broker, you could be doing construction, whatever. As long as you are more than 10% owner of whatever the company is where you're spending your time, it doesn't even have to be on your property. You could qualify as this real estate professional. You just have to materially participate on your properties, which is like a second step. If you are just hiring property managers, you could qualify as active, but there's a phase out on that. Active equals a $25,000 a year loss that you can offset your W-2 income with, but it phases out between $100,000 and $150,000. So if you make less than $100,000, active participation is your friend. If you are making over $100,000, real estate professional becomes your friend. Only one spouse has to qualify. I am a commercial GC. Yeah, so Colin, if you own your company, would you qualify as a real estate professional? The answer is yes, under the first prong, and then you still have to materially participate on your real estate. And we group all of your real estate activities together. In material participation, there are 7 different tests. Somebody says, I don't own it, I'm an employee, then it wouldn't count. You have to be a greater than, I think it's 5% or 10%. And then a loan officer, no. It depends on how active you are in the transaction. Most of the time, you guys tend to lose. Sorry, because they say you're not in the actual transaction. But if you are helping broker the transaction, then yes, you could qualify. But don't get too flustered about this. We don't know whether it's going to be relevant or not. So let's do the cost seg analysis. This is 15-year property. Oh, no, excuse me. This is 27.5 or 39-year property. This right here is 15, and this is your 5 and 7. So we look at your blinds, countertops, cabinetry, specialty plumbing, window treatments, wall coverings, floor coverings, anything that's like, again, carpet or removable flooring, could be your laminates, your landscaping, irrigation, storm drain, sidewalks, all that other stuff. Outside would be 15-year. It doesn't really matter to us because any of these under 168K, we can write off 100%. 100% in year 1. And I'm not misstating that. Anything less than 20 years under bonus depreciation, I can write off in year 1. And let me show you exactly what it looks like. So here's a case study on cost seg. And I'm going to use a little highlight. Oops. I'm going to use a magnifying glass if I can find it. So we break it down, and you could see, hey, if I just did regular depreciation, here's the regular depreciation without a cost seg, is this one right here on the far, here, I'll put a line around it, I'll put a big red arrow. This is without a cost seg. So you could see year 1 we're getting 21,000, year 2 we're getting 43, 43, 43, 43. If we decide that we are going to,